All right, I think we can start. So what's up, everyone? My name is Ruslan. I know that some of you might be from the grad class, which got canceled today. So hope you enjoy the undergrad class if you're here. Otherwise, Dahlia right now is in New York, so she won't be able to stop by. So this lecture is I'm gonna cover it essentially. And if you're an undergrad, your final assignment is going to be very relevant to what we're going to talk about today. So if you haven't looked at it yet, I encourage you to just do a quick skim, just so you can sort of parse this information in a useful way. But otherwise, yeah, we're going to talk today about market microstructure. The naming is loose. So yeah, first of all, let's just briefly cover the plan for today. We're going to primarily talk about two mechanisms today. It's gonna be the order book, and it's gonna be the automated market maker. Both of those mechanisms are a way to create an exchange. And just to start the class, can somebody just tell me in very basic terms what an exchange is?
Parties can bid on like a price or a fair market value.
Yeah, exactly.
Price information.
Exactly. And additionally, they also swap the ownership of the asset while they are doing that. Yeah, exactly. It's essentially a place where you can trade. It's a relatively simple concept, but when you actually go into the details on how those mechanisms are implemented, especially if you consider things like how they're implemented in TradFi versus how they're implemented in crypto, distinctions are going to matter and the mechanisms are going to differ. So let's start with an order book. To start with a raise of hands, has anybody heard about an order book before? And is anybody familiar with the concept of an order book? 1, 2, 3. Right, some people. So the idea of an order book is that it's a real-time registry, essentially of orders, for a specific asset. On the slides, I'm going to talk about, just abstractly about assets, but I'm going to speak about Bitcoin. Let's just assume that we're talking about an exchange where Bitcoin is traded. It's going to be easier to understand, I think. So roughly the way order book looks like is on this picture on the left-hand side. The green area is sort of orders to buy Bitcoin or just any asset. The red orders are orders to sell an asset. And the x-axis is the price. So essentially, the buyers are going to be willing to buy for a smaller price than the sellers will be willing to sell. And the x-axis is the size. So if you're looking at, let's say, the price of 3 cents, or what is that? Yeah, whatever, 3 cents. There might be 2,000 of Bitcoins offered at that price. The spot price of an asset is roughly the price at which you can immediately buy or sell it. In other sort of words and visually speaking, the order book is going to look something like this. As I said, you have the x-axis, which is the price. You have the y-axis, which is the quantity. On the left-hand side, in green, you're going to have the buyers, the people who are willing to buy the asset. On the right-hand side, the red bars are going to be the sellers, the people who are willing to sell the price. And just so you intuitively sort of understand this picture, imagine that you want. No, I think I'm getting ahead of myself. We're going to talk about it in a second. Are there any questions on this sort of high-level idea of an order book? Yeah.
To me, it seems kind of similar to like a supply and demand graph.
Exactly.
Represented in a different way. Is that like a way to think of it?
Yeah, exactly. It's like essentially an order book is a mechanism to discover the price for a specific asset. And we're going to talk about how exactly it does that. But it is true. If you want to buy something on a bird's eye view, you're probably going to want to buy it for a cheaper price, which is why you're on the left-hand side. If you are going to sell something, you're probably going to want to sell it for a higher price, so you're sort of on the bigger side of the x-axis, which is natural for the economists in the room. On a high level, for the purpose of the assignment and for the purposes of introduction into the order book, you just need to know two order types in the order book. The first one is the spot order. In other words, a spot order, or it might be called a market order, it's the order that gets immediately executed. You might think of it as, I want to buy Bitcoin right now at the best available price. That's going to be the market order. And the limit order is the order when you specify not only the quantity that you want to purchase or sell, but also the price at which you want the order to be executed. Let's go over an example of a spot order. Suppose that you have this order book. This is the state of it. You have different price levels, and at different price levels you have different buyers, sellers, and the quantity that's being either bought or sold. And so suppose that you want to buy 3 assets, 3 Bitcoins, let's say. What it means is that you need to find somebody. Of course, you're not actually going to search for it. It's going to happen algorithmically. But it means that if you want to buy, somebody should be willing to sell to you, right? If you want to buy 3 assets, it means that there should be a seller for those 3 assets. And the market order generally works very simply, actually. It just tries to find the best price by walking, in the case of a buy, the seller side, and just matching you with the sellers, essentially your order. And this is how the trade happens on an order book. In our example, where you want to buy 3 assets, you are going to buy 2 assets at the price of an $8, because there is somebody who's willing to sell you at $8. And you're also going to buy an additional single asset at the price of $9, because the next liquidity that's available there is at $9. So the way the order book is going to look like after your market order is executed is something like this. You just took away the liquidity at $8, you matched there, and also you took a little bit from $9. So this is the state of the order book after the spot buy trade. And I don't think I mentioned it, the spread is essentially the difference between the best buy and the best sell order, and why it's relevant we're going to talk about in a second. For the purpose of the example, let's do the opposite order now. Suppose that you now want to sell 3 assets. What does it mean? It means that somebody has to buy those assets from you. And for that purpose, we have the buyers in the order book and the orders who are willing to buy an asset. So it's going to look very similar for the market sell order. It's going to walk the buyers from the best price to sort of the worst price, and it's going to match you against them. So right now you have somebody who is willing to buy an asset at $6, and somebody who is willing to buy 2 assets at $5. So what your order is going to do is it's going to sell 1 unit of an asset, 1 Bitcoin, to the person who is willing to buy it at $6, and it's going to sell 2 assets to essentially the second price level. And your effective price of the trade, can somebody tell me what your effective price for this trade under these conditions is? Like, what's the actual price that your trade was executed?
Is it the weighted average?
Yeah, and what is it?
I can't do that.
16 divided by 3.
Exactly, it's $5.3. That's your effective price of your sell. All right, super simple. This is the state of the order book after your market sell trade. And as you can see, the spread again increased. The difference between the best buy and best sell increased. So now let's talk about spread in particular High-level idea of the spread is that the tighter it is, the better the market. Can somebody tell me why? Let's make it interactive.
Dahlia always said the same.
I know. Yeah.
Does it mean there's just more competition, there's more information being shared, and like anyone can execute their trade as soon as they want, pretty much? If the spread is almost touching.
Yeah, I mean, high-level idea is true. I'd say, yeah, that's the right answer. To sort of add on it, if you're thinking about an exchange, what are the properties that you want? Ideally, you want to be able to sell and buy at roughly the same price. Before I personally learned about the way order books work, I thought that exchanges are some magical mechanisms that always let you trade either you're buying or selling at the same price, and it kind of works somehow. But in reality, it doesn't work this way. And if you're talking about an illiquid market where the spreads are very high, you might be able to sell an asset for, I don't know, $5, but buy it for $9, which is like a huge difference in prices. Which is why you want tighter spreads. It's just if you have a tighter spread, it means that you have more liquidity, generally speaking, in the market. And you get better prices. This slide is roughly what I just said about the spot price to buy versus spot price to sell. If you have, generally speaking, for deep markets, you're just thinking about the spot price as a single thing. But if you are talking about illiquid markets, it might be that the spread is very wide. So it might be useful to think about the buy spot price, or the immediate price at which you can buy something, or the sell spot price. Vice versa, right? Any questions on anything we've covered so far? For those who haven't looked at the final assignment yet, this is essentially what you're going to be implementing, but on Ethereum. No questions? Sick. I don't know for the grad class, but for the undergrad class, one of the things that Dahlia mentioned in the latest class was Hyperliquid. Hyperliquid is like an incredible project, incredibly successful project. The #1 company by revenue per employee in the entire world, not for crypto. And this is sort of the order book, just so we look at the live thing, for SpaceX on Hyperliquid. The order book is right here on the right, and it's sort of the 90 degrees clockwise. If you turn the diagram that we were looking at before, this is what this order book is. And the reason why I wanted to look at it is this is an extremely efficient market. There is a huge amount of liquidity. There is $13 million 24-hour volume, huge amount of open interest, and even still, there is a small one, a very constantly fluctuating but spread. Like right now, there's 2 cents of spread, right? Even for a very efficient market. Also, just to mention it, a careful listener might have noticed, what the hell? Why is there a market for SpaceX? SpaceX is a private company.
Yeah.
Well, first of all, SpaceX is going public, I believe, next week, June 11th. But this is actually not what's called the spot exchange. You're not actually trading the shares of SpaceX, but you're trading a derivative contract for SpaceX. Essentially, you're betting on the price. And essentially, Hyperliquid here is doing the price discovery for this pre-IPO stock, which I think is pretty cool. All right, yeah.
You mean they're betting on the price of what the stock is going to be when it IPOs? Or like
what they exactly do is, we wouldn't have time to talk about perpetual futures right now, but it's like you're buying contracts that give you exposure to the underlying asset on a high level. And the idea is, if the underlying asset goes up in price, and let's say you bought a buy order, a long order, in other words, the contract is going to pay you. Otherwise, you're going to pay the counterparty. That's the super high level idea of perpetual futures. But yeah, the way if I understand it correctly, because I haven't looked into that particular market on Hyperliquid, they get the spot price of SpaceX from private markets. So there are some private markets like Forge, where there is some form of price discovery happening for SpaceX even now. And they are betting on that price. All right, limit orders now. A limit order is simply the order where you also specify the price at which you want that order to be executed. For example, if the spot price, if for a market order, you might say something like, I want to buy 2 assets right now, give me the best price. For the limit order, you might say something like, I want to buy 2 assets at $10. And the bars that you're seeing in the order book, either green or red, those are actually the limit orders. So for example, this bar right here, is there? Yeah. This bar right here is a limit order for $4, and the quantity is 3. So somebody placed a limit order to buy 3 units of an asset at $4. Vice versa for sellers, works the same way, but in the opposite direction. As an example, suppose that you want to buy 2 Bitcoins at $5. Terrible price, I hope we're not going to get there. But what you can do is you can open a limit order at $5 in particular. So the way it's going to look like is your order is going to appear on the order book at $5 in the quantity of 2. What does it mean? It means that if somebody comes into this order book and does the spot buy order, they're gonna buy the asset. My bad. If somebody gets into this order book and does the spot sell order, they're gonna sell it to you at $5. Right? If they're doing the sell of more than 2 assets, again, it works the same way. It's just gonna iterate from best price to worst until the liquidity is exhausted. The exact same idea applies to limit sell orders. So if you have 3 units of Bitcoin, for example, and you're willing to sell it for $8, you can place a limit order, and it's going to be added to the order book. By creating limit orders, as you might have noticed, you tighten the spread. Or in other words, you make the exchange more liquid. Essentially, by doing that, you let other traders enjoy better price by exchanging there, and less sort of like the effective price of the orders that they're executing is going to be better. So you might have thought about who are those people who are placing those orders. Because I don't think anybody in this room actually ever placed a limit order, right? You might have placed a market order. Did you place a limit order? No?
Yeah.
You did? So, all right, one person. But generally speaking, if you're thinking about buying an asset, you're not thinking about placing a limit order, you're essentially placing spot orders. And you would be right to assume that retail traders are never actually placing those orders in the first place. The entities that are generally responsible for placing those orders are called market makers. And those are specialized entities, companies even, who are responsible for essentially quoting, placing those orders on the exchange. And they generally, you might ask why? Why would they do that? 2 one reason, but there are two sort of sub-reasons behind it. The reason is they're making money doing that. And how are they exactly making money? The first one is they make money on the spread. If the spread is wide, they might sell you an asset for a higher amount and then buy it from you for a smaller amount, make money that way. It's called making money on the spread. And the second way, some of the exchanges might actually go ahead and pay them money to do that, because the incentives, the exchanges are incentivized to have deeper markets. So what that really is that on two sides of the exchanges, whoever quoted at $5 and at $9, or let's say at 8, might be the same person, or might be the same entity. All right, that's everything I have on order books. Any questions? Perfect. Relatively simple. Now throw back to 2014. What was created in 2014? Ethereum. The first Turing-complete blockchain came into existence. And if you wanted to do any sort of computation on Ethereum, you'd have to pay gas, essentially execution fee. And the problem here is things like loops are generally expensive. And what is an order book under the hood? It's essentially a loop. When you make a market order, you're looping over the orders and matching each individual one. And it might get really damn expensive. So, which is why there was a demand surfaced for a different kind of mechanism in order to create exchanges. Like, okay, we can't really host an order book on chain. It might be too expensive. Is there something else? And Vitaly Buterin in 2016 proposed the idea of an AMM, an automated market maker, in a Reddit thread. This thread created like $100 billion of worth of markets, which is, I think, interesting. But on a high level, the idea of the AMM is that it's a mathematical model, that's how I like to think about it, for how trades should be executed based on the supplies of two assets. Might be confusing at first, but think of an AMM this way. It's a smart contract which holds two assets, might be Bitcoin and US dollars, and the AMM is going to tell you if anybody comes in and trades those assets for one another, the role of the AMM, or the underlying mathematical model, is to essentially answer questions like, if I have X amount of token X, or token A, and Y amount of token B, what price should I quote a trader? At the root of AMMs, the idea of a mathematical curve is used, and which curve exactly we're going to talk in a second. Yeah, this is essentially what I just said. I'm going ahead of myself. But just to reiterate, the AMM is going to give you the answer to questions like, what's the spot price for a particular trade based on the amount of assets that are in what's called pool or an AMM. As an example, consider the case when AMM holds 10,000 USDC and 30 ETH. And I want to trade ETH for USDC. The AMM is going to answer the question of what's the price for this trade ought to be. Yeah, also there's a side note. A pool has the liquidity in the first place. You might ask the question why. In the order book, the role of supply and liquidity is generally on market makers, but in the AMM, it's different entities called liquidity providers. think of them as people who just deposit the funds into the pool, let other people trade, and earn swap fees from that, or trade fees. All right, now to math. Surprisingly, this is all the math that you need to understand an AMM. The underlying formula for the AMM literally has two variables. It's X and Y. X is the current amount of some token A, think of it as USDC or ETH, and Y is the quantity of the amount, the token B. Again, if X is USDC, let's say Y is ETH. And K is just a constant number, which is equal to the multiplication of those amounts in the first place. So the example we gave before, when the pool holds 10,000 USDC and 30 ETH, the K would be, what, 300,000. And the idea of an AMM, no matter how many trades that you make, like you might swap ETH for USDC, then USDC for ETH, K must remain constant. My question right now for all of you is, how does the curve look like here? The curve X times Y equals K, how does this curve look like? For those math interested people, yeah. It's a hyperbola, exactly. Exactly. Visually speaking, you should think about it as a hyperbola, that's right. And all the valid amounts for both X and Y, the token quantities, should at all times lie on this curve. Let's just use the example that I gave initially as our building block for sort of giving examples about how AMMs work under the hood. So if we have 10K USDC and 30 ETH, it's roughly going to be at that point of the curve, up there. And the price that the AMM is going to quote you, roughly speaking, is going to be Y divided by X. So makes sense, right? You have 30 ETH in the pool, you have 10,000 USDC in the pool. You do 30 divided by 10,000, you get the price of 1 ETH in USDC, I believe, right? Yeah. 1 ETH would be equal to roughly, wait, I think it's a bit wrong. I think it should be X divided by Y.
Yeah.
I mean, it depends, like, if you do Y divided by X, you're gonna get the price of USDC in ETH. But if you divide X by Y, you're gonna get the price of ETH in USDC. So like depends on which price you want. But in this case, 1 ETH is gonna be worth approximately $333, given the current state of an AMM. So how does trading happen? Again, let's say I'm a trader, and I come to this pool, I say, I want to exchange some X prime amount of USD. I have X prime USD, I want to get ETH. What are you going to quote me? The current amount of USD in the pool is X, and the current amount of ETH in the pool is Y. So the new amount, like no matter what happens, all else equal, the new amount of USD in the pool after this trade is going to be X plus X prime, right? X is the initial amount of USD, X prime is the amount that I'm supplying to this pool. That's the easy part. But how much ETH should I receive from this trade? Given that the formula that we have, X times Y, the amount of both tokens should always be equal to a constant number K. The amount of Y prime that I should receive can be found by this formula. So the new amount of USD is going to be X plus X prime, we figured that out. then if we're going to receive y prime of ETH, we don't know the amount yet, but the new amount of ETH in the pool is going to be y minus y prime. And if you multiply those amounts by each other, we remember that at all times, they should be equal to k, to some constant k. Now to some math, like nothing super scary here. The idea is you gotta isolate y prime. You know everything else. You know y, you know x prime, you know k. You just isolate y prime. And what it turns out to equal to is roughly those two formulas. I like the bottom one more because it doesn't have k. But it's y minus this fraction x times y divided by x plus x prime. And this is exactly the amount of ETH that you're going to receive from this AMM if you perform swap of x prime USD. Let's go over an example to actually harden this intuition better. Let's say in the initial state is the same. Let's say that you want to swap $15,000 for ETH. So currently the amount of our y equal to 30, x equals to 10,000, and x prime is going to be 15k. So the new amount of USD in the pool is going to be 25,000. So x prime, like you might think of it visually this way, x prime is going to increase, so your new x is going to be sort of right there, like to the right of the x-axis. And my question to you right now is, given this visualization, where on the chart is y prime? Can somebody give me the idea, based on everything we've covered so far, where y prime is on the chart? Yeah.
X prime is essentially the change in x, y prime is the change in y. So the distance from the top corner down to the curve.
Exactly, that's exactly right. Y prime, given that the amount of tokens in the pool should always lie on this curve, we know that the uy is gonna sort of lie around 12 there, where this red dot is. So the difference in y, if the initial y is 30 and the final one is at around 12, is going to be y prime. Exactly, like this is how you might think about it. So the approximate amount that they're going to receive, it's our guess, is roughly, what's it going to be? Like 18 ETH, right? If the amount that's going to be left in the pool is roughly 12, so the amount that you're going to receive, y prime, is roughly 18, right? If we actually do the math behind this example, y prime is actually going to turn out to be 18. Like, this is the amount of ETH that you're going to receive from the trade. And the AMM is going to have 12 ETH remaining. Any questions so far? I know if you haven't heard about AMMs before, it might be a super confusing tech. Any questions? All right, and what's useful about it is you just make one evaluation of the formula. It's way cheaper to do on the blockchain than running a full-fledged order book. Swaps in another direction work roughly the same way. By another direction, I mean, let's say you're swapping, you're giving some amount of ETH, you want to receive USDC or USD. It works exactly the same way. You're just isolating x prime, not the y prime. And visually speaking, it's also going to work exactly the same way. If your y prime is given, and you know that the valid amounts have to lie on this curve, you can also visualize x prime as that sort of top side of this triangle, whatever, arc. And the yellow dot is going to be the new state of the pool after the swap. Any questions? Again, just one evaluation of the formula. Super cheap on chain. Perfect. The problem that is inherent to AMMs is what's called slippage. In the example before, we started with the immediate price of 1 ETH being worth $333. We swapped 15,000 USD for 18 ETH. So the effective price of the swap, if you divide 15K by 18, is going to turn out to be $833. So even though the AMM quoted you an effective price of $333, if you make a large amount of swap relative to the pool reserves or AMM reserves, you're going to suffer from this price slippage. Generally, slippage is not just inherent to AMMs, it also exists in order books. Because we, in the example, if you remember, let's say we sold an asset, the order book had the best buy at $5, but you eventually, the effective price was like $5.3. And if you sold a sufficiently large amount, you would also suffer from slippage. But for some reason, I don't understand exactly yet, AMMs saw a huge critique specifically for slippage, as if Orderbook doesn't have it. All right, this is slippage. Any questions on slippage? Perfect. Yeah, do I want to talk about this? No, I don't. Who is interested in stablecoins? I'm considering if I should talk about this. Meh, a little bit. All right, on a high level idea, stablecoin is just a token that's worth $1. You might have heard about USDC and USDT. I'm just going to be quick about it. And if you have an AMM for USDC to USDT swaps, it might be the slippage problem might be pretty dire. If you got quoted 1-for-1 price, like that AMM might quote you at par, but you swap, let's say, 10,000 stablecoins of one denomination for the other, you might get the effective price that's terrible. So those two slides are essentially saying that if you had the initial quantities of 20K of one, like 20K of USDC, 20K of USDT, and you swapped 1,000 USDT for USDC, your slippage would be like 5%. So your effective price would be roughly 1.05, which is definitely not like $1 for $1. Next, this is a pretty dense slide, but I think it showcases another problem of AMMs called impermanent loss. So on a high level, impermanent loss is if you're supplying liquidity, if you're a liquidity provider to an AMM, you're the person who's making money from swap fees. Essentially, the impermanent loss is the difference from your gains, the difference between your gains if you just held some capital rather than supplying it to an AMM. It's hard to understand it on a high-level idea, which is why we're going to cover the example. Let's say that you own 1 ETH and 1,000 USDC. And currently in the AMM, there are 9 ETH and 9,000 USDC. Therefore, 1 ETH is worth $1,000 in this example. Now suppose that you provide your assets into the AMM. The math behind that is simple, relatively simple. So now the AMM has 10 ETH and 10,000 USDC. So still the price of 1 ETH is $1,000. And you own 10% of the AMM's reserves. So the K in this example is going to be equal to 100K. Suppose now exchanges don't just live on chain. So somewhere on Binance or Coinbase or just some centralized exchange, the price of ETH went to $2,000. All right, since the AMM doesn't immediately react to that price, the price only changes when people trade. It still has a non-updated price. So people are gonna naturally start purchasing ETH from the AMM at $1,000 and selling it to a centralized exchange at 2,000. It's called arbitrage. And this is gonna happen until the price of the AMM is gonna be roughly the same as the price of on the centralized exchange. So what you want is the price y divided by x, or x divided by y, sorry about that, be equal to 2,000. When is that the case? That is the case, oh, actually, I have x here as ETH and y here as USDC, so this is actually right. So you want the price, this is gonna happen, the arbitrage is gonna happen until the fraction of those reserves is equal to 2K. If you actually count that out, it's gonna happen until the amount of ETH in the pool is roughly 7.07, and the amount of USDC in the pool is roughly 14,000. So after that happened, after arbitrageurs sort of bought from you and sold to the centralized exchange, now the pool owns those quantities, 7.7 ETH and 14K of USDC. And you are still entitled to 10% of it because you supplied initially 10% of value, so you're still entitled to 10% of it. So your share of this pool is 0.707 ETH and 1,400 USDC. So the value, the market value in USD terms of your 10% share is 0.707 times 2,000, because Ethereum is now worth $2,000, plus 1,400, which is roughly equal to 2,828. And by the way, your initial value at the initial prices of $1,000 was just 2,000. So it looks like you made $800 profit. Started with 2K, but ended with 2,800. However, if you never put in the capital in the AMM in the first place, you would have 1 ETH, which is worth 2,000, and $1,000, which is $1,000. So a total of $3,000. This is impermanent loss. Impermanent loss is the difference between, as I said, what you could have earned if you just held versus if you supplied to the AMM. Any questions? Perfect. And yeah, in this case, impermanent loss is equal to 172. This is roughly the comparison of the AMM versus the order book. Let's just go over one by one. So the pricing mechanism in AMM is continuous. You can have literally any price, but on an order book it's discrete. So you have different price levels. Do spreads exist on AMMs? No, they don't. There is no notion of spread. You might say that slippage is kind of spread, but in the natural sense, spreads don't exist on AMMs. They do exist on order books, of course. The price discovery on an AMM happens algorithmically. On the order book, it happens based on open orders. And AMM can actually hold not necessarily just 2 tokens or 2 assets. It can hold as many as you want. It's like roughly called multidimensional AMMs. And Orderbook generally has just two assets, like USD or ETH, Bitcoin or USD, whatever. Impermanent loss exists only for AMMs. And yeah, on the high level, slippage is roughly higher for AMMs. And yeah, I would argue with that. But roughly those are the differences between an AMM and Orderbook. Another, the reason why I created this presentation in the first place is because I was trying to root for AMMs and try to present some benefits related to AMMs. Don't necessarily agree with it still, but this is still true. One of the benefits that AMM has is that you can sort of tailor the curve to your specific use case. Some of the use cases are, one of the use cases actually directly related to stablecoin pairs that we talked about before. Another example of the type of the AMM that exists is called constant sum AMM. The first type that we covered, which has a multiplicative sign, is constant product, and this is constant sum. Very similar math-wise to the constant product AMM. The formula is x plus y equals k. Again, my favorite question, how does the curve look like? Have x plus y, k is constant. If you think of it as a curve, yeah, exactly. It's just a straight line. It looks like this. So it's a line where y is equal to k, the initial value of k, when x is equal to 0. Algebra 101. And swapping assets also follows a very similar formula, where you have the updated cost, updated x token value and updated y token value, but now you're adding them, still equals to constant k. But the swap logic, the interesting part about this swapping mechanism is that if you actually try to isolate x prime and y prime, you're going to find out that x prime and y prime is always going to be equal to one another. In other words, a constant sum AMM is just an AMM that always quotes on par. Generally speaking, it's a useless idea because asset prices fluctuate. You can't quote on par. You can't quote one-to-one at all times. However, there is one use case when that actually works. It's stablecoins. If you have an exchange between USDC and USDT, you might argue, some economists might not agree with you, but you might argue that it is beneficial to always trade them on par. So yeah, this curve is useful for stablecoin applications. However, it has a problem that a typical constant product AMM doesn't have, is you can completely drain out one side of the liquidity. If you started with 2020 supplies and traded either y prime or x prime being equal to 20, let's say you bought x. If you bought x, it means that the x amount got reduced by 20, and the new amount of x in the pool is what? It's 0. So now if somebody else wanted to buy x from the pool, they wouldn't be able to do that. And that's, pretty problematic. So constant sum AMMs actually are never used in production. It was just the idea that was described in order to present some hybrid approaches that actually got adopted, or at least they found some PMF product market fit. So hybrid approaches like stable swap, which is the curve deployed by Curve as a company. It's a curve that acts close to how constant sum curve acts when assets are roughly in balance to one another. So when the supply of one asset is, let's say, 20, and the supply of the other asset is, let's say, 21, roughly speaking, the curve is going to act as the constant sum. But if you get to the point when one asset gets slowly drained, it's going to start acting as the constant product formula. So here the red curve is actually the stable swap curve. Near the equilibrium, it's very similar to the straight line. Near the edges, it's very close to the hyperbola. This is not actually the formula used by stable swap, but it's close. It's called this way. We're not going to go over. One interesting thing about this formula in particular is that you can't isolate x prime and y prime if you actually try. So one of the methods that you can use to, if you wanted to create like the AMM with this specific formula, is you can do a binary search for y prime, for example. Yeah, just keep that in mind. So let's consider the example again. Before, when we had the USDC and USDT pool, our slippage was what, 5%, roughly 5% when we had 20K of both tokens and tried to swap 1,000 of one for another. Again, in this example, our initial asset amounts are going to be 20,000 of both, and we are going to swap $1,000. So if we swap 1,000 USDT for USDC, if you actually go ahead and find the sort of y prime, the amount of USDC you're going to get from the pool, how much do you think you're going to receive? You're giving 1,000 USDT. Just to eyeball it, what do people think is the amount you're going to receive in USDC for that curve? No right answer, of course. Oh, there is, but it's like
1,000.
Like exactly 1,000.
Not exactly, but it's approximately linear.
You're right. It's really close to 1,000. It's going to be this much, 999.94. So the slippage is that number, very small. So for a specific use case like stablecoin to stablecoin swaps, this is just the idea that I was trying to showcase with the tailoring benefit, is that you have the power to decide which curve that you're using. And if we try to create an exchange for stablecoins, this is one of the curves that we might actually use. That's all for order books and AMMs. Any questions on anything from this lecture or from the final assignment? Yeah?
When is the final assignment due?
I think it's due 12, I think. It should be on Canvas. It should be on Canvas. So there's time. Just to reiterate, the final assignment is to implement the order book on Ethereum, not the AMM, because it would have been pretty easy to do an AMM. Any other questions? All right, we still got